Well, time now for another In the Legal Know with Vincent J. Russo. And Vincent joining us here in the studio with information, very important information, on qualifying for the capital gains exclusion when selling your primary residence. Vincent, very important information right now.
Good to be here.
And I think a lot of people don't know, they're not fully informed on this one.
Absolutely.
Yeah,
and it's tax season.
Yay.
So tax returns have to be filed by April 18th. And so if you sold a home last year, you have to report that sale on your tax return. Very important. And we want to take advantage of the capital gains exclusion that can save thousands of dollars. So the starting point is to figure out what your selling price was. And it's the net selling price. So it's after the expenses for the closing, like the broker's commission and the legal fees. And then you have to figure out your basis, which is what you purchased the house for. And if you made improvements, that adds to the basis. If you inherited the house, then it's even higher. Mm-hmm. So you have to figure out your basis. That'll get you to your gain. Once you figure your gain, then you have to figure out, can I qualify now for this exclusion?
Okay, so give us an example. Who would qualify? How does someone qualify?
Okay, so let's start with an example. We can take a look at selling a house for $750,000, a single taxpayer. And let's say the basis is $250,000. So they bought the residence and made improvements. So they have a gain of $500,000. Now, if they have lived in the house, owned and lived in the house 2 out of the last 5 years, they can take a $250,000 capital gains exclusion. That means they're only going to pay tax on $250,000, not $500,000. And depending on the tax bracket they're in, that tax is going to be about $37,500 or as high as $50,000. But that's half of what they would have paid if they didn't qualify for the capital gains exclusion.
Okay.
So a very important tax opportunity 2 out of the last 5 years. Now, married couples, we can get up to $500,000. All right, so another example, wow. Same selling price. The basis is $250,000, the gain is $500,000, and that exclusion can be $500,000. So if either spouse or both own the house 2 out of the last 5 years, and they both use the house 2 out of the last 5 years, they qualify for that $500,000. That offsets the gain, brings it down to zero.
Wow.
And the capital gains tax is zero. So we just saved somewhere between $75,000 and $100,000 in taxes.
Oh, wow.
That's a lot of money.
Now, what if you already took advantage of the exclusion on a former house? Can you do it again?
Yes. So you can only take advantage of the exclusion once every 2 years. All right? So if I took advantage of that exclusion 5 years ago, and now I qualify again with the second home that I'm selling now, I can take it a second time. So there's no restriction. Under the old laws, you were only able to take advantage once in a lifetime. Now you can take advantage every 2 years, literally.
Wow.
And what many taxpayers don't understand is that there are a lot of exceptions to the rules. And so if a spouse passes away, there's a modification in the rule so you can take advantage of the exclusion as a married couple. Or if you go into a nursing home, they change the rule to make it more advantageous to qualify. Or you can get a partial exclusion in certain situations. So it's really important to get the right advice. If you sold your home, there's a lot of money here. Up to $100,000 could be at stake.
Wow. Okay. What do you need to do? What if you want to put this into your tag? What, you have a special form? What do you?
Yeah. So now we get to the reporting piece.
The reporting piece. Okay.
So there's a 1099-S form that's issued when a sale occurs, and that's issued by a taxpayer. So the form you're going to report this on is Schedule D 1040 and Form 8949. Those are the two forms that have to be filed with your return. If you want more information, go to the IRS.gov. go to publication 523 or topic number 701, and that'll give you some really good information on what you need to know.
Okay, again, tax day, April 18th this year.
April 18th.
And anybody who sold their house this year needs all of that information.
That's right. If they don't report it with that 1099-S, the IRS will be questioning you. You don't want to have an audit. Make sure you report the gain.
Thank you, Vincent. As always, thank you.
My pleasure.